Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by unprecedented demand, I am delighted today to be able to host the third Capital Markets Summit with four giants of the investment industry, namely Martin Gilbert, chairman of Assetco and Revolut, Chris Watling, founder of Longview Economics, David Buik at AQUIS Exchange, and last but not least, Justin Urquhart, Stewart, founder of Regionally and the Daily Mail's very own Mr. Moneymaker. So welcome, gents.
Welcome.
Hi. Now, Justin, welcome back to the UK after your break, and you certainly brought a big correction on the markets yesterday. So I understand you're self-isolating, but it used to be, I'd have thought sort of like, the Freedom Day would have been positive for the markets, but to have such sort of like take such a bath on it, are we entering a more of a sort of like a possible correctional bear market, or is it just really a sort of period of summer doldrums?
I don't think it's going to be doldrums. I think it's going to be quite an exciting. So I think it's going to be quite an exciting summer when you see all the things that are going on. I love the idea to have Freedom Day, and the first thing you see is a demonstration in Parliament Square of people having to go at the police. So on that basis, it might be better being locked down anyway, or was it just locked up? No, there are a whole series of elements at the moment, which means, in my view, we're not going to have a quiet summer. Yeah. And therefore, for investors who like trading, I think they've been throwing up some great opportunities. And also, there may be some quite dramatic drops, which for longer-term investors might provide very good entry points as well. So actually, just looking as it was quite nice to be away for a week or so on a boat when you're going to find out every so often what's going on. But you come back, the factors are still the same. Nothing's really changed. It's just that maybe sort of the slight attitude in terms of prices. But the combination of actually having now, obviously, the continuing concerns over inflation is there, still quite rightly. Therefore, that's a direct line to what happens to interest rates. We knew all of that before. We just don't know when. But of course, with the extension of COVID, I see now all 50 states in America are saying now they've got rising levels again. But that adds to another level of concern. But against that, you've got a position where corporates generally have been looking really not bad condition. Those that have been still in a position to start still moving forward have restructured their debt, restructured their business to a great extent, and are now looking far more effective and efficient for when things get better or have a bit more confidence to them. And the other issue, of course, is cash and access to cash, which means that the private equity or anybody else involved in any form of takeover work is going to have their book pretty full this year with lots of opportunities to be able to be going through. There'll be black nights and there'll be white nights in this. There are some good private equity firms and there are some horrendously bad private equity firms. My general view is I don't like them because they're too short term. But nonetheless, it will mean for us as investors opportunities to actually see where those markets move. Because bear in mind, you don't have to buy the stock that's about to get taken over. You just have to buy any of the stocks because any of the ones next door may well get taken over. It'll roll on. It'll have the effect to the rest of the sector. A lot of that we saw yesterday as well. Yeah. So just on that sector rotation, Martin, what's your sort of like your fund manager guys at the coalface saying to you in terms of overlaying the COVID sort of concerns and the sort of like the problems we had yesterday? Are they treating it as a very short-term sort of thing in terms of looking at the longer term, or are they looking at it sort of like this is really taking a bit of steam off the market because it was pretty elevated?
Yeah, I mean, I think everyone's still pretty relaxed about it. I mean, it's short-term blip. I don't think any of us see it as the start of the equity bear market. But just going back to the point on PE, I'm chairman of Revolut, and the private equity firms are still investing at sort of pretty good valuations. So we at Revolut raising $800 million at a $32 billion valuation. So
well done.
PE firms are still active, putting in money into growth. So they're quite happy to buy growth. So markets seem in reasonable condition. It's as Justin said, it's whether there's cash or not, and asset managers are having quite a lot of call on their cash at the moment. So it's quite in that respect, it's reasonably tricky for them.
So basically what you're saying is that there's a big sort of mountain of cash on the sidelines that will look to redeploy. So they'll be buying on the dips, which should put some support under the overall markets. Yeah, Chris.
Yeah, and they're cautious about buying new issues. So especially off, as just said, off private equity. So yeah, but I agree, very interesting summer ahead of us. Rotation into value has been great.
Yeah, that's been the trade du jour, hasn't it? Now, Chris, talking about the sort of the economic outlook and all things sort of inflation and bond yields. I mean, when we last spoke, again, you were super bullish in terms of sort of, I think it's an extenuated K sort of like format for the economy, and you were spot on, absolutely spot on, because we've had a real sharp rebound, and now we're entering a sort of more gradual sort of recovery phase. What's your sort of view, and how, in particular, the Fed and central bankers are going to react, because they're really getting pulled from both sides on the inflation side, but also if we do have a sort of like a soft patch because of COVID, then they're going to get sort of like dragged down to not start tapering early and push back interest rates, and then they're going to have to take a lot of heavy lifting in terms of getting abuse for running the economy super hot.
Yeah, it's actually a very good point. I mean, in my darkest moments, I wonder if the market's going to bully the Fed into not tapering. But we will find out. I mean, that wouldn't be a central case scenario, but it must be a possibility. And yeah, I mean, I think markets and the economies are doing what they always do. We've all lived through a bunch of bull markets. The first year is fantastic. You generally price in 30% of the whole bull market in 1 year. You get it in 1 year. And then global growth rates peak out in year two, and the market struggles for 6 to 9 months. And that's really the phase we're in. And to be honest, it wasn't just yesterday. We've been building to this for a couple of months. I mean, if you look to Japan, it peaked in February. China's done nothing since China New Year. The industrials, the cyclicals have been tracking lower for a number of weeks. And really, what we've had is a very narrow market in the last 6 weeks, which is basically 4 stocks driving the whole thing high across the globe. And of course, the FANG stocks are the culprits. So a lot of chat in markets about narrowing breadth that we've seen. And that's very consistent with this idea that global growth rates have peaked out in the last few months. That's not to say global growth is going away. I don't think it is. I think this is a classic consolidation phase, give back a bit of those gains, sort of reposition. Trades were very crowded coming into end of Q1, beginning of Q2. So, yeah, there's a lot to worry about. You raise inflation, people worry about growth, but I certainly don't think we're going into a bear market. This is a classic sort of phase 2 lull, classic year 2 lull that you get after you rush out the gates in year 1 in a bull market.
Yeah, I don't want to put you on the spot here, Chris, now, but I will, okay.
Not much.
but if you took away sort of like you started tapering, where is the 10-year yield going to be on the Treasury? And where are we going to peak out on inflation, and for how long? I don't want to ask, because that's simply the 2 biggest questions that investors are trying to grapple.
Well, it's like Keynes said, isn't it? You can have a forecast, but you can't do time and point. You can only do one or the other. I can only give you a level or a time. So I don't know. I mean, economists are brilliantly famous at not being able to forecast inflation. I think, we have to accept that. Personally, I think it's transit, and then I do think inflation pressures will come back for various reasons. The world is very different to what it was post-financial crisis. One thing in particular, super, super important here, post-financial crisis, banks in the West spent 5, 6, 7, 8 years rebuild. So they weren't investing in recovery. They weren't pushing the recovery. They weren't pushing growth.
Good point.
The world completely different now. Those banks are stuffed full of money, stuffed full of liquidity, stuffed full of capital, and they want to get going. They want to lend it out to someone. So we will get inflation on a sustained basis, but at the moment, a lot of it is one-offs and opening ups, and everyone's talked about second-hand car prices and semiconductor shortages and this and that. I mean, my own fridge for my new outdoor garden is still 5 months waiting to arrive. So That wouldn't have happened pre-pandemic. This is all sort of getting the supply chains going again. So I wouldn't worry too much about it short term, but longer term, I think we've got a problem.
Okay, so you ducked the question there, Chris. I get it. Okay.
Did I duck it? I didn't realise. I thought I answered it.
Yeah, okay. All right.
Sorry.
All right. Well, David, now, what's your sort of view, top level view? I know sort of like you were thinking about sort of the more the political angle, because that's really quite interesting, and also the overlay of sort of, the health side, the medical side. What's your sort of your take on it?
I think my biggest worry, Paul, is I'm not having much hair on my top of my head. I'm not going to have much more fairly soon, because I'm very disenchanted with what I call the global political leadership. The vacillation, the prevarication, the lack of decision-making process, some really poor decisions. I mean, this pandemic's not easy for anybody. I mean, it's impossible. Yeah. But I think what's happened in some of these fantastic growth rates that people have been forecasting during the course of the next 6 months to a year are just simply not going to happen to the same degree. I mean, I'm very interested in what Martin has to say, but I'm so disappointed in the Japanese governments, particularly since February, which Chris flagged up. The Nikkei's dropped 10%, and that's because they didn't pay attention to their vaccination programs, and the Olympic Games is an unmitigated disaster as a commercial operation. And if you go to Europe, I think the prevarication done there, because nobody can make a decision because it's 27 people. I think the relationship between the UK and Europe is appalling. I think that we're still waiting to see the whites of the eyes of Joe Biden. And is America still first, second, third? Or is he really interested in getting involved? And all these things, I think, will stunt growth rate. I'm not negative on equities, and I'm not negative about life in general. But I think we were always going to have this phase. It was never going to be as pointed and as aggressive as we all thought a year ago.
Yeah, I think we've just lost Martin, unfortunately, on that political angle. He's back. Excellent.
No, he's there.
Martin, can you take that question? Well, because obviously you speak to some of these political guys sitting in ivory towers and stuff like that, rather than actually them living in the sort of the coal faces and being locked up. What's your view? Will they make a sort of like they slip up because they're not really sort of coordinated? I mean, with the Japanese is a very good point. And obviously, Boris hasn't been unknown to drop the ball occasionally.
Yeah, I think David's right. I mean, the lack of leadership is really amazing, isn't it? I mean, it's all run by focus groups. Every decision is tested on a focus group first, then leaked, and then made, and then retracted. So it's. I agree. It's strange, and you're right about Japan. I mean, they must be hating. They must be hating these Olympics when more than half the population are against it. And but I don't know what it's difficult, but they've got to stop running the country by focus group. That would be my advice to them.
Yeah. Just on the M&A sort of angle, which you touched on with the private equity, Justin, I don't know. I mean, obviously, you look at stocks all the time. I know you've talked about, so even Unilever was talked about being an acquisition target, I think, by the guys over in Heinz sort of like a few years ago. Do you think that trend is going to continue? They're looking at a UK PLC and thinking they're licking their lips and saying it's very, very cheap, and so
it's going to continue.
Justin?
Well, they're very simple. Yeah, sorry, my line is rather poor. I apologise. It's going to continue, and the reason is there's access to investment money and access to borrowing, so that's all quite cheap and easy to get hold of. There are some good quality assets which will mean that it will attract buyers. And if companies are of a mind to have themselves to break themselves up or to actually sell themselves, then it will happen. However, what is interesting this time is, of course, we've got a much more, I think, engaged set of investors who tend to be having more of an attitude about whether they should be defending the companies, participating in that, rather than just necessarily, as they have in the past, just roll on their back and have their tummies tickled. So something like Unilever is a classic example where it can carry on quite happily as it is for donkey's years. However, if you actually do get some aggressive investors in there are a fantastic array of brands, all of which, if you add that together, would provide some exceptional value. And there are lots of companies like that around. So every company at the moment has to have be on the front foot in terms of managing their story, their shareholder story and their value. Because if they don't, then others will, I'm afraid, be taking advantage of it. So every company has to be going out with messages saying, we're as good as we are right now. And if I'm failing at it, then you'd be prepared to be attacked.
David?
Can I just want to ask one question, if I may. The thing that worries me about me is that over the last decade, we've seen the United States of America become very protectionist. I mean, no company seems to have gone out of Germany and France since the old king died. And they're very protectionist about selling their operations. Now, I'm very much a free and an open market man. But what we don't want to do is to see our companies sold to Uncle Tom Cobley and all for the wrong reasons. I mean, I think there is this case currently at the moment going on with Morrison's, where they think it may be a touch of the old asset stripping and, you know, the property and all the other things.
Barbarians at the gate, KKR. Well, isn't them, but it's all the big PE guys.
Yeah.
Boys.
I mean, do we think we should do more in this country about protectionism, or do you think that that is a negative term for investment?
It's negative.
I agree, but, you know, we are losing a lot of companies, aren't we?
I agree, but Spire's a good example of where shareholders, Tosca, where I'm chairman, stood up to the bid from and survived. So if you've got good shareholders, I think that's the key. But Morrison's is a really good example, because that does look like a good, well-run, conservative company owning its own property assets. Looks as if it might be taken out.
Yeah, just on that, the sort of the M&A thing, Martin. Obviously, you know, you're the chairman of Assetco, and you obviously got, I think, you know, you are the chairman of River and Mercantile. The whole asset management industry is going through a big consolidation phase. How do you see that as a sort of like shaking out in terms of, because that's real sort of insight into a particular vertical?
Yeah, well, as you know, this move from active to passive has hit the big guys quite hard. So there'll be consolidation at that level. But I'm especially positive on what I would term the boutique sector of asset management, which is where fund managers leave larger companies, set up on their own, and tend to just do one thing rather than the big guys do everything right across to private markets. And that's something that's really affected the big asset managers, this move from public markets to private markets. And people talk about 5 or 10% of world assets, of world markets actually doing that. So I like the small sector, where I think you can get good fund managers doing what they're good at and focusing on it and not having too much capacity. So yeah, I'm positive in the sector, because people, more and more people have to look after their own wealth going forward, and asset managers and brokers or wealth managers are the place to do that.
Yeah,
certainly should do well in a bull market, shouldn't they? I mean, it's almost impossible not to make money unless you've got a big bearish tilt.
Yeah, but they have been in a 40, 50-year bull market, because no matter what the stock markets do, short-term fluctuations, the amount of money going into wealth managers and asset managers keeps going up. So it's a good industry. And the average profit margin is 30-40%. So it's a profitable business to be in.
I'm not surprised the fees are coming down.
Yeah, exactly. The big customers are focused on fee levels, and that has spilled over to the retail investor. So now the retail investor is getting a better and better deal.
Yeah, Chris, just on your when you speak to the your professional institutions, the ones you advise and stuff, are they giving you any sort of thoughts about which sectors are most sort of like in the crosshairs for M&A? I mean, obviously we've seen the asset back, the supermarkets, we've seen the basically St Modwin go as well, infrastructure, housing, this sort of John Lang, and then we've had obviously the software boys have also been starting to pick up. You had Sumo yesterday, and you've had a whole bunch of other sort of like guys and tech. Are you seeing any sort of, where do you think the activity will be in the M&A in the sectors?
Where's the activity going to be? Great question. I mean, certainly in the States, a lot of it's been in the tech. But I think the main point is there's so much cash around. As I think David was saying earlier, if you want to borrow money from the bank, they're falling over themselves to lend it to you. Yeah. Markets are falling over themselves to give you money. Look at the SPACs, the trend in SPACs in the US, which have been reversing into all these sort of interesting tech companies, all different types of companies, whether it was Virgin a while ago or all sorts of other things. It's fascinating. And I think the cash and the amount of liquidity in the system, the bank's ability to lend is going to keep driving a strong M&A boom whilst this continues. Personally, I think buying banks going forwards for the next few years will be a terrific trade. So if I was chairman of a sort of startup fintech bank, I'd be over the moon.
Oh, yeah.
I don't know if we know any, but clearly, as Martin's just demonstrating at the moment, I think you were front page of the FT the other day, weren't you? As the largest fintech in Britain or something along those lines. So I think that's a very exciting area. Seeing new challenges to the financial system and the way it operates is very exciting, and technology being applied there. But yeah, I think generally lending, classic banking, all those sort of trends, the modern day versions, the tech versions of it are going to do very well over the next few years.
Yeah,
the issue is for the private investor to get access to it, and I think that's holding back. It's getting but access is coming, I think, for private investors to participate in private markets. But beware, you do give up liquidity, so the private investor has to take that into account before they invest in these more illiquid markets.
Yeah,
but I think it's sorry, excuse me. Sorry, I was just going to say it's not just the new tech banks, but also the old school banks. I think will do remarkably well because we're going to have a multiple year housing boom, and what they basically do is lend mortgage debt. That's their primary function. Most of our old school UK banks. So. Yeah. I think it's going to be good for a few years.
Justin?
Yeah, just extending that a little bit further, and I suppose talking to David's book as well as partially mine, actually broadening out the market for investments. Now, a lot of these areas will be going through the likes of AQUIS and others, companies coming through and providing greater opportunity for investors to look at. Because our markets, the numbers of listings have not really been increasing at the rate they should have been. And particularly, actually, in those more exciting tech companies, a lot of which actually tend to get scooped up just when they're coming to the stage where they're becoming good growth businesses, need more capital, can't find access to that capital, and so end up being taken by private equity, which are both still going private, but it's nice to see more stuff on the public markets there. We still need to expand those markets, so whether it's AQUIS or what we're trying to do at Region, it's the same thing, giving private investors greater choice of investments and possibly at the smaller, very exciting areas. Bear in mind, these are high risk, but exciting, growing businesses, not just startups, but growing businesses, which they can participate in directly, not necessarily just through funds.
Just on that one then, David, I mean, what are you seeing at the coalface of AQUIS Exchange? I mean, the amount of IPO activity, frankly, in the last 3 months has just been phenomenal. And we've had, company after company listing.
Yeah. But if you think, Paul, that the dearth of them from the banking crisis in 2008-9, when people they pulled back, and it's taken a long time for confidence to be boosted. And now the opportunity, particularly in the fintech world, and any technology world, because they know these companies will probably never survive on their own, but the long-term add-on value they do to the big giants in the industry will eventually buy a lot of them out. So there's a huge amount of enthusiasm. I mean, I can't remember exactly how many AQUIS have done in the last 3 or 4 months. I think it's 15 IPOs. But, there are some of them medium-sized and some of them are tiddly, but it doesn't matter. Because what it does is it's drawing, interest right across the spectrum. And the most important thing, and I think Justin would support me here, is get the retail investor involved. Don't always make it funders and the professionals. Get people involved right from day one. And if you do that, you find you've got liquidity. I mean, one of the reasons I'm so anti-AIM is no liquidity. The shareholder registers for most of these companies is rubbish. And if you don't have shareholder registers, lots and lots of different shareholders, you're not going to have any liquidity. And I think that's extremely damaging for what potentially are some very good businesses which never really get the accolade that they probably richly deserve. I'd like to take Chris up on one point on the banks, of which he and Martin and others seem to be massively enthusiastic. And I suspect they know more than I do. I'm very excited by Martin's Revolut, because I think that's the way forward now. I think the competition that is provided, Wise is another one. They're going to give the banks a lot of grief in terms of the profit margins they got, being able to transact business much more cheaply than the current situation is. I mean, the American banks, I think now on the whole are in pretty good shape. I will always be interested in Goldman Sachs and JP Morgan. They dominate the M&A market far more than they should ever be allowed to by anybody, but that's the fact of life. And Morgan Stanley, you can probably chuck in there. But apart from Barclays Bank, who have got, this presence in the United States, particularly in fixed interest, for the life of me, I mean, I know you look, I mean, I made some notes this morning. Lloyd's is up 25% since the beginning of the year. And NatWest is up 20.84%. Whoop, whoop, whoop. How much are the taxpayer losing on these people? They're never going to go push forward, in my opinion, to the same degree, because frankly, much as you say mortgage lending is great, it is, and it's a really lucrative business, they haven't got enough arrows to their bow to excite my taste buds. Guys, you know a lot more than I do. Tell me I'm wrong.
Go on, Chris. I don't know if you want to take that. I mean, just to add to that, just on the valuation, though, the US banks are valued at about 1.5, 1.6 times book, whereas the UK ones are about less than half of that. So there's a huge valuation catch-up if they can ever get their return on capital employed anywhere near the US peers. But Chris, I don't want to take any words.
Absolutely. I mean, I'm not really. I totally concur with you that Goldman's and JP are great banks, and then far better than many of our banks over here. But that's not really my point. My point is, I think we're in a multi-year boom for housing and lending into that sector, mortgage supply. So, as Lloyds banks themselves say, 67% of their loan book in the UK is mortgages. So it's no more complicated than that. It's going to be volume. I honestly think I'm a great believer in the 18-year land cycle, and we got the best 4 or 5 years ahead of us, which are the last sort of boom years. So I think the UK economy will boom. So if you look at consumer credit, for example, as another form of lending that they get involved in, it peaked in 2005 relative to GDP, and it's about halved. I mean, it's come off further in the pandemic. So there's a ton of capacity on balance sheets to re-leverage, and there's banks that want to push the debt out the door. So don't get me wrong, this is not a great economic growth model. I'm not suggesting this is but it's the way it works. So yeah, that would be my thought.
Yeah, just on the reopening trade, Chris. What if there's going to be a sort of a boom? I guess all of the more higher beta sort of like reopening stocks. Maybe potentially the restaurants, the airlines, the leisure, all this sort of stuff. What are your views on that? Will they continue to work? Because they obviously came up strongly on the rebound, but they've fallen back because, say, yesterday they took a bit of a bath. Certainly the cruise liners. What's your sort of view longer term on those guys?
I think they'll work because I think they're just pausing along with all the other cyclicals. They're a bit like deep cyclicals at the moment in the sense that they're because of the way the reopening's working, and the shutdown. But I think I just think we're going to see earnings continue to beat expectations because the consumer's going to boom for a few years, and it's not just the cash on their balance sheets. There's a ton of other stuff. And
you still need your fridge, don't you?
I still need my fridge, so I'm going to buy another one just in case I can get that one quicker. No, absolutely. I mean, I think it's coming. I do, and worth picking up these stocks so when they're beaten up, basically. Yeah,
Justin, what do you want?
I think this is a really crucial point here because people are looking for some opportunities this summer. The story of IAG we talked about before, and of course it's benefit on the recovery, but of course it's all been blown away again by the COVID issues and the current issues, but the same story is still there. So it's not a matter of just companies coming through. Those companies which take advantage of the past.
We're losing you, Justin.
Get rich.
Yeah. We were losing you then. Can you just repeat that?
I was talking about. Just talking about those companies that have taken advantage to change over the past 18 months, not just see their share price down, but the likes of IAG changing their pay levels, reducing them to a great extent, changing their fleet, restructuring their debt, raising more cash, putting them in a position where they are now very strong. So the same story that was there last year is there again this year.
Well, if that's the case, Justin, if that
do recover out of this and all the various.
If that's the case, Justin, you obviously are positive about business travel. You're obviously positive about business travel. That's going to return because that's the key central thesis for British Airways and for Iberia and people like that. Justin?
And it will return, and it won't be at the same scale as before, but it will be there, but not at the same scale as before. And so those companies that have adjusted for it will take advantage of it. Remember, some of their competition has already disappeared.
Yeah,
so it puts them in a much better position.
Yeah.
Air, but it's a classic. I think they'll do extremely well in the next 6 months to a year, because I think they're better geared up than pretty much any airline in Europe in terms of taking on the challenges that are required, which is sort of short-term travel, immediate access, and, the fact that they're always there, where others have had to adjust too much. I think they're going to find it very difficult picking up the slack.
Yeah, well, I think
the Revolut of the airline sector, aren't they? They're the nimble operator without legacy issues. I'm very taken with Chris's point in the property market, and presumably people should fix their mortgages then as part of a strategy. If you're going to run your property, there'll be a time over the next year or so to actually take advantage of these great fixed long-term loans. I've always thought government should be borrowing 100-year money at the moment at less than 3% and investing in infrastructure. And inflation will take care of the rest.
Yeah, that's a very good point. That's a no-brainer, isn't it? You borrow money in 100 years, invest in infrastructure. You can't. It's a great trade, isn't it? It's a good arbitrage, really. I would agree.
3%
fix your mortgage.
Just on that sort of the reopening theme, Martin, on the commodities and emerging markets, obviously those guys did well at the start of the year, or so it was actually other than China, but and India got a bit bashed. But certainly on the commodity side, the commodity guys, the miners did really well.
Yeah.
And now they're sort of like they're coming off lumber and iron ore and this sort of stuff. What's your view on these guys? Because they're obviously gone.
Yeah, I'm on the Glencore board, so see it firsthand. I mean, the interesting thing is obviously the boom in electric cars has really helped the Glencores of this world with cobalt and copper. Up until now, it's been the iron ore guys that have been doing really well, but that's slowed down a bit. So the BHPs and Rios have had a boom time. I think what and looking at it from the investor's point of view, what we all want to see is not mass capital projects, which is what has ruined the miners in past cycles. But this fight with China for Australia is quite a big thing, both in coal and iron ore.
Yeah. What, Chris? What's your view on? I don't know if you have a view at all on the oil, crude oil, because that's obviously done well, and now you've had OPEC Plus deciding to actually increase the sort of their output going forward and trying to get back to pre-pandemic production, which was about 100 million barrels a day, I think, by the end of next year. And that announcement coincided, unfortunately, with the wobble yesterday. So you had WTI falling about 7%. What's your direction of travel on that one?
Well, arguably that announcement was part of the WTI, the wobble in markets in general, because it was part of the risk. No, look, I mean, OPEC's discipline is breaking down. I think that's what we can see now at a time when the price is quite high. And it's a real dangerous time in the market in terms of, what shale coming back on in the States. We're starting to see that come again.
Yeah.
I think oil's going to do what every other commodity's been doing. A big peak, and then a big give back. And lumber's the great example. Copper giving back a bit. We're waiting for iron ore to come off a bit, and I think oil will as well. But having said that, I think watch it for 6 months. It'll find a level, and then it'll be very interesting. I know people tend to avoid buying energy assets these days, but I suspect give back some of those gains, and there'll be maybe it's 50. I don't know what the level is, but watch for it to be oversold. And I think some of those assets, as I say, will be quite attractive in a few months' time. But no doubt about it, OPEC discipline is breaking down at the margin. And with oil at 70 plus as of last week, it was very.
How much is that down to Russia being very difficult? I could use Anglo-Saxon terminology, but I won't.
Well, that's all part of the equation. But of course, UAE with the big trigger last week, pushing back, and then we had Abu Dhabi over the weekend. So I think the reality is the OPEC, old OPEC guys gave up a lot for the non-OPEC in OPEC plus, if you like, the Russians primarily, and they wanted a bit of that back. But yeah, so and let's not forget, it was only March last year there was a breakdown in relationships between Saudi and Russia that was part of the reason. Obviously, the pandemic was the main reason the markets sold off, but the volatility in oil was a big contributor to that. So, yeah, so it's quite fragile, those relationships. And I think we're seeing the beginning of the breakdown. And by our view is, we updated our numbers yesterday, the market's going to be flooded with oil next year. We're going to have far too much oil. Yeah. So unless they start reining it in, you know, we need prices lower.
And what's your view, David? Because I know the big sort of like integrated oils, the Shell and the BP, that's going to be pretty negative for these guys, I guess.
Well, I mean, you know, BP and Shell share prices at the beginning of the year has bounced around like a cork in a bath, isn't it? I mean, BP's up, I think, 10.5% since the beginning of the year, and Shell are rather parsimonious 3.5%. And I think what both the management are having huge problems with is getting this transfer away from oil into the other types of energy that they're looking for. And, you know, when you said BP, right, I'll take an $18 billion hit last year because we've got to get out of these certain assets and the rest of it. And, you know, we're going on to see with the renewable energy and trust us. And then you find out that they spend the best part of 900 million for some wind operations, which I understand from other people who know much more than I do. They've spent far too much money on them anyway, in terms of value. I do worry. It's like the old tanker syndrome. You never go from A to B without it being a pretty tortuous journey. And I think Bernard Looney has really chewed up probably more than he can handle at the moment in actually sort of trying to get BP into it. I, personally speaking, would give BP and Shell personally a body swerve. And I think I'd probably just like to see how they get on in the next year. Whereas if you said, would you put a few quid or a few euros into Total, I'd probably say yes. Yeah,
it's amazing, actually, the amount of investors, professional I speak to, who it's oil and gas is no touch now going forward.
I don't know enough about it, no.
Yeah. Just one sector that actually is getting a lot of attraction, healthcare. Now, I did see the Mr. Moneymaker recommending a fallen angel in the sector, Clinigen, in the Daily Mail about 2 or 3 weeks ago. What's your view on the broader sort of medical healthcare sector? Just because it's entering a golden era of change and science and all this sort of stuff, and it's throwing up sort of opportunities as well, because it's actually pretty cheap in terms of historical perspectives, and also in relation to PEs of other sectors.
You've got to be very careful with a lot of these, because you can buy the big farmers and you're buying a nice broad scale. But of course, they have huge, great development plans. As you know, things can take a decade to come through. But nonetheless, you're buying that sort of scale, and you're buying their ability to go and select and buy up all the small development companies that have come up with something interesting. So that's for someone who doesn't want to take too much risk. The ones I quite like are the smaller ones, where they've actually got contracts already in place. They see that what their particular drug or element they're producing has been accepted. But they will make them very volatile, because there will be concerns over the contracts in the future. So those ones where you actually do see some fallen angels on it, if you think their contracts are right and they've actually got some long-term commitment to it, and as long as the product itself is right, and of course, I'm no chemist, so I wouldn't know. You have to go on to extent of what you think, how well that's gone so far. That, for private investors, can provide a very interesting opportunity. So a few of those to be following. You don't buy into them straight away. See how that share price, how it works. Yeah. See just what the element is. And when it breaks out, why is it broken out? And if you still have confidence in the contracts, of the management and the product, then you go ahead and buy it. And I think we'll see more of those.
Yeah. Another area that seems to have obviously, done well in the pandemic is the tech and software. I don't know if you give us your view on that area, Chris, because I know you talked about it last time, and it's sort of split between the sort of the long duration assets, the EVs, and the guys that have just bid up at 100 times sales, the snowflakes, which have been bouncing around, to say with David's expression, cork in a bathtub or whatever. And then you've got your more sort of like your FANG stocks, which are sort of like secular growers that have really paused for breath at the start of the year and now sort of taking the market higher. What's your sort of top level views on software and tech?
Yeah, I think you're right. You've got to split them that way. The Microsofts of this world are really defensive growth now. They're kind of how we used to think about healthcare 20 years ago. Steady earners, steady growers, good growers. And they're a bit of a play on bond yields in a sense, and we've seen that with the FANGs in the last couple of months. But there's no doubt that the tech in general is extremely richly priced. And if there's one thing to really worry about in the global stock market, it's the valuation of tech and growth stocks. You know, it's the ARC phenomena. You know, the ARC Innovation ETF, all that sort of stuff is jam full of money, retail money, hot money. And particularly the second line techs I worry about. So I think for me, bond yields, they're tracking lower for now, but they're going to be pushing higher towards the end of the year into next year. And that's when you don't want to own tech. So it's a bit of a reprieve for tech, but really over the next few years, I think that sector is going to be much smaller as a share of the global market cap when we look 3, 4, 5 years out.
Yeah. Okay, well, let's get around the table in terms of sort of opportunities. If you want to kick off, Mark, what's just sort of like your preferred sectors or preferred stocks? I know you've sort of like you've just raised $800 million for Revolut, so I think that one's obviously attracting a lot of capital. But outside of the sort of the asset management side, any areas that you'd sort of like investors should want to run the slide rule over?
Nothing changes for me. It's still Asia. I still think Asia's the great opportunity. China's fantastic. India's fantastic. And ASEAN. What's your view
just on China? I mean, they're battering all the tech companies out there, particularly the ones which are listed, the DD, and you've had Tencent having a bash in, and you've also had Alibaba as well. And that can't be very good for attracting new investment, presumably.
I think when you invest in China, you know you're investing alongside the government. So it's not a country to take on the government. I think I've said before, China, you want to be as close to the government as possible. India, you want to be as far away from the government as possible. Yeah. So, you've got to work with the companies need to work with the government, and they've got a great ability, haven't they, to put people back in their place when they see when they see people probably listing in the US when they don't really want them to. They'd far rather they were listing in China. Yeah.
Okay. David, what's your sort of like areas that you would sort of like point investors to have a focus in? I mean, you obviously don't like the banks and the oil and gas. You'd have a body swerve.
I don't like some banks. I mean, some others I get. I'm hot to trot. But I mean, basically, if you want me to pick out 3 sectors, one is fintech.
Yeah.
Because I believe it's a real revolution, and I believe there's serious competition for the banks as well, and I think they're going to do incredibly well.
Yeah.
I'm very much in Justin's camp. Is that I like biotechs for value on value. You live by the sword, you die by it. If you get the right one, you're going to make a lot of money. If you're wrong and you don't write contracts, you're going to lose your shirt. But if you do your research properly, I think it's really exciting. And the other one, because of my past, I can't resist it, gambling.
Gambling? What's that?
Yeah, I'm afraid I'm very interested in companies like William Hill, MGM, Flutter, companies like that. People, the more they're struggling, you won't believe this, the more they gamble. And that's a sector that I keep a very watching brief on, and I smile benignly like a Cheshire cat because I think it's very, very exciting and offers great opportunities in the future.
Well, I think we're all in the right industry then in that case, because I think the biggest gambling area or casino is the stock market at the moment, particularly with Robin Hood traders and the amount of sort of rotating of sectors and where the money's heading. So, Justin, what about you? Where would you say sort of like people should have a good look at? You've talked about AIG, and then you looked at sort of like some areas in healthcare. Justin?
Yeah, I have to say, just reinforce. Can you hear me? I hope.
Yeah, we can. Yeah.
Certainly, as I said last time, and I haven't changed my view hasn't changed. I have to say, agree with Martin. I'm an ASEAN fan, if only because the family's there. But no, you can see where that growth is coming from. Yeah. The rise of the Oriental consumer is a continuing story and not going to go away. There's money and there's growth value there. So I'm still very encouraged by all of that. One thing I know, possibly the dullest thing, but worth remembering, particularly during a period of volatility when people are going back.
Justin, you're going to have to repeat that. Justin, you're going to have to repeat that.
Must not be forgotten. No, okay. One of the areas we mustn't forget it can be incredibly dull, is the fact that actually we're seeing companies now paying dividends again, and therefore the power of compounding, it may not be as exciting as picking individual stocks, but creating longer-term value for people in their family funds and pensions, that's absolutely crucial. Can sound pretty dull in comparison, but with all the other ideas we've got, which are perfectly fine and good, this is a key area for us to remember. Second element to remember also only follow a few stocks which are reasonably liquid, and become an expert in those. Remember the old Zulu principle and it's absolutely right. So during the summer, this is a classic case where you're going to see your favored stocks benefiting from some volatility. And you'll see when they break out of those price ranges, you'll know more about those companies than frankly most of the analysts, if there are any, are following the business, and you take advantage of that. So actually, volatile summers, I think, can be incredibly helpful, and a downside more interesting than lying on a beach assuming anyone's going to get to one.
What about you, Chris? Where do you see some opportunities? I mean, across all asset classes, obviously, you're very positive on property. You think that's going to have a long-term boom, etc. Yeah. And obviously, the economy is going to be sort of doing well. We're going to have secular and reopening growth certainly for next year, despite the sort of the pandemic, etc. Where would you be where you see money being put to place?
Tons of opportunities. I mean, it's a long list. We mentioned the banks already, but I think, and I would agree with Justin, take advantage of volatility over the next month or two to put money to work on the long side. Buying stuff. I would also say, one of my favorite correlations out there is global trade and Southeast Asian equity markets, to Martin's point, and I think Justin and everyone confirmed that. And global trade's basically been flat for 12 years and is now breaking out to the upside. And if I'm right about this global consumer boom, it's going to keep going to the upside, and these Southeast Asian markets are going to love that because they're right in that big global export supply chain. So I like those. I like the reopening stuff as we get into Q4. It's going to be a really fun fourth quarter. I'm really looking forward to it. Get through the summer. I'm going to the beach, and by the time we get back, we should be ready to rumble.
Are you saying fun on a positive way, or are you saying fun on a negative way?
I like volatility. I like it when it's much more interesting when markets have some tough days. People get a bit shaken up. It's very boring when I know it's good for making money. I understand that. In the long term, markets go up. So I just like the odd moment of fun.
Just on that sort of volatility side, are there any sort of big risks? I mean, Martin, I had a very sort of like educated institutional fund manager who was saying actually in China, he was seriously concerned about a big blow up in the debt market, the bond market there, because I think it was one of the big sort of real estate guys isn't being bailed out by the government. And he was concerned that actually you've had an explosion of yields out there in the sort of subprime basis, and that could lead one thing to another. But is that any other risks, or that risk, or what's your view?
I think just it's the government again teaching people who they feel are getting a bit out of control a lesson, aren't they?
Yeah.
They want to bring it back to. So look, there are risks everywhere. I agree with Chris. There's risks wherever you look, and you could convince yourself to sit in 100% cash. But if you sit in 100% cash and inflation, you're going to you get killed. So really, the only place to be is equities or real assets. Basically, you don't want to be in bonds, do you? I mean, you're going to lose money in bonds. So
yeah.
It's pretty simple. It's just finding the right equities. It's always been the same, hasn't it? I mean, just pick a fund manager who can pick active equity stocks, and you're home and dry. Give your money to someone who can make the right equity decisions.
Yeah, just on
like David and Justin,
just one top risk that was obviously unnerving the markets. Has anybody got a view on the COVID sort of situation in terms of variants? Is this something longer term that people should be worried about, or is it really the Delta all the vaccines are good for keeping people out of hospital, and the boosters should basically be able to give people extra protection in the autumn and winter, and therefore it's a bit of a non-issue and the fear's overplayed? Should we be buying this, or is there anybody on the other side of the trade thinking this is a real issue, or any view?
No,
COVID is a real issue. Sorry, Dave, carry on.
Go ahead, Justin. Go ahead.
COVID is a real issue because there will be other variations. Well, it's been used all over the place the past week or so. We've got to live with it. There will be other variations. There are other vaccines which will be managing it as well. They're going to have that volatility, and it will be one of those other factors that frightens the market. And of course, there will be other things occurring, other forms of disease we've never heard of yet, which will have an effect like this. But actually, having lived through this, economy, as world global economy has managed it really rather well. Also, I think politicians have now, as far as they have any understanding, some understanding of how they should work through it. So, yes, it's still going to be there. It's going to be one of those factors which will rattle the market from time to time and give us some volatility. And for traders, we like volatility. For longer-term investors, ignore it, invest. You're heading for the straight for the future, and let your compounding do the rest.
Okay, good. All right, well, we'll call it a day there, guys. Thanks very much for your time again. Fantastic insights, and best of luck for everybody with their investing. So take care, guys.
Thank you.
All the best. Take care.
Bye, guys.
Thanks.
Thank you.
See you.
Bye.